Here in this video, we're going to be going over my expectations for Tesla stock over the next coming days, weeks, months, as well as the broader markets. Now, you are going to get an update on this Israel conflict, and on top of all of that, you are going to hear Dan Ives' reaction to earnings from Tesla. He did cut his price target down to $310. Previously, it was $350 here today. You are also going to hear from Gene Munster, which does have more positive things to say about Tesla, especially Tesla going into the future. Now, as you guys do know, Tesla stock down about 10% today. Not exactly the greatest day. So I think this video is very important for all of you guys to pay attention to. Let's go ahead and get into it. Hit the like button as well as subscribe to the channel. If this is your first time here, consider sticking around a while. It's free 99. We do our best to keep you guys informed each and every single day on Tesla stock as well as the broader markets. If you guys want to take it a step further, come trade with us. Come get access at least to my trades in real time. Every time I make a trade, I send out alerts. Link down below in the description of this video. Let's go ahead and get into it. But let's first off establish what happened today. Tesla stock down 10%. You are getting bonds just absolutely getting destroyed. Nobody wants to touch the bonds with a 10-foot pole. TLT up about or down about 2% today. This means that your actual treasury yields on 30-year treasury is up almost 11 basis points today, and your 10-year treasury yields up almost 9 basis points today. 10-year treasury yields are almost higher than 5%. This is already a new high that you have seen in the last 15, 20 years or so. If it continues higher from here, you have a big problem on your hands. This banking crisis might not be over. The lower TLT goes, the more unrealized losses banks have on their balance sheet, the more stress that is going to be out there in the banking system. This is not great. Just to add on to Tesla earnings, which were not great. Now, I've been very vocal on this. I do think the biggest risk to our market is not the Fed raising rates again. It's not the economy deteriorating out of nowhere. It is going to be this overseas conflict. Now, if you take a look at the dollar today, the dollar is down about 0.5%. That is good. But if you take a look at gold, gold is up another 1.11% today. You are getting like the worst case scenario happening for our markets. You're getting money flowing into gold, usually the dollar, as well as oil. Oil is up another 1.62% today, but you're not getting money flowing into treasuries. Investors, they're fearful, but they're not buying treasuries. They're actually selling treasuries, causing yields to go higher. What you normally see is investors buying treasuries, causing yields to fall when there is a lot of uncertainty, when there's conflict going on around the world. That is not happening. Instead, investors are buying gold. This is really showing a lack of faith in really the dollar in bonds. Nobody wants to own a 20-year treasury bond. Are you kidding me? That sounds crazy to a lot of investors right now. That is really bad because you're getting money flowing out of stocks. It's going into gold. It's not going into bonds. So it's essentially leaving the markets. That liquidity is leaving each and every single day. This situation overseas, if it does have an implication for oil, this is called a choke point with oil. 20 to 30% of the world's oil flows through the Strait of Hormuz. This is in between Iran and Saudi Arabia. If they want to cut this off, they could cause gas to hit 10, 15, 20 plus dollars a gallon, depending on where you live. Now, that would obviously be really bad. That would have upside effects to inflation, but that would also have real consequences to the economy. So in a weird way, this actually happening, if it did happen, if this conflict does escalate, which it looks like it's going to, it's just a matter of time, this could actually force the Fed's hand to U-turn, to become more accommodative, to get bond yields down lower, which stocks might like that at some point, but that initial kind of conflict reaction would not be good news. And that seems like the direction that we are heading in as of right now, especially following this latest news. Even CNN is reporting this. Israeli defense minister says troops near Gaza will soon see it from the inside. This conflict does not escalate until you see an invasion into the Gaza Strip. Once that happens, that's when you need to be on lookout for your Black Swan event. Your Black Swan event does not happen until Israel goes into the Gaza Strip. I don't know when that will happen. I don't know if it's could be tonight. By the time it's nighttime for the US, it's daytime over there. I'm sure if it were to happen, it's probably going to happen early morning, afternoon time, somewhere along those lines, right? So it could happen any one of these night times. That's the unfortunate part about this. If it does happen, it's probably going to happen when markets are closed, okay? So that's something you kind of have to be hedged for now, or kind of, be hedged for now, essentially. That's what I am currently doing. My portfolio is hedged. A lot of your guys' portfolios are hedged if you are in the trading community. Again, if you guys want to come hedge out your portfolios, link down below in the description of this video. But this situation, it's not getting better. It's getting a whole lot worse. Israel is pulling their diplomats, their embassy members, out of basically all Middle Eastern countries. Again, another sign of further escalation in this conflict. And this is the biggest catalyst that could send Tesla stock much, much lower. At least that initial move, that initial reaction would be very negative. In that case, you could see Tesla at 150 pretty easily. I don't think you fall under that over the next coming weeks and months. As a business as a whole, as a forward-looking guidance, just commentary on the earnings call, it was a disaster. We had no clarity. We have no idea when price cuts are expected to end, where Tesla thinks margins are going to go. Very, few questions were actually answered. And that's something Dan Ives goes into here in this video that we're going to play in just a moment. But I think this does provide more of that downside room. Now, me personally, I'm a long-term investor in Tesla. The long-term thesis has never been stronger in Tesla. I would love to see Tesla at 150. I would sell my kidney to buy more Tesla stock at 150. Shoot, you get it lower than that? Yeah, now you're really talking money, okay? The lower you can buy, the more your upside is going to be, the less risky your position is, the lower Tesla goes. Am I selling Tesla stock? Absolutely not. Am I looking to buy more? You betcha. Now, your next stop is that 200-day moving average. If you don't find support here, if you don't bounce, then you're surely falling, to about 180. If this conflict were to actually get worse and you were to get an Iran or Hezbollah and the US involved, that's where you could see even further downside, down to about that 150. That would be my expectation over the next couple of weeks or so. So there still could be a lot of downside from here. I do think there is that chance of getting the oversold bounce. Tesla is at 29.55 on the RSI. So usually when you get to 30, you tend to see a bounce. Besides back here in January when the stock was at 100, that was because Elon was, selling stock, funding the Twitter deal. That was a little bit different than any other normal time. Usually you do see an oversold bounce. That is definitely a possibility here, but I don't foresee a lot of big upside from here unless we were to get really positive news about margins or free cash flow in regards to the Cybertruck. Elon made it very clear. The Cybertruck is going to hurt margins. It's going to hurt free cash flow for 12 to 18 months. In this market, when rates are 5.5%, the markets don't care about 12 to 18 months. The markets care about the next 3 to 6 months. So that was just way too long for the markets to comprehend and be okay with waiting for. So maybe we do get better news than that. Maybe Elon, they come out and say, hey, we were wrong. It's not going to hurt margins as much. That could be positive. But other than that, I just don't see Tesla stock going up from here in a considerable way. I don't see you getting back above 240, 250, 260 anytime soon until that does happen. So I do think your risk here is for a continued downside move, but to see an oversold bounce again at that 200-day moving average at $214.17 up to about 230 would not surprise me. Just any upside above that would definitely surprise me. All things considered, this geopolitical tension situation is probably not going to get worse. It's or better. It's probably going to get worse, and you're probably going to see more downside out there. Now, I'm a little bit more doomy even on the NASDAQ, because the NASDAQ in particular, this is how I'm hedging out my portfolio. It's really the last shoe to drop. If you look at equal weighted, S&P or even the NASDAQ, you're down 10 to 15% for this year. So bull market where? There's no bull market. Technically, sure, but that's because the largest stocks really control the weighting. Those are the ones that have done well. On the NASDAQ, the QQQ, the NASDAQ 100, you could probably see the NASDAQ fall to new lows of this cycle if this conflict does start to involve the US, Iran, Hezbollah, things of that nature, especially if oil does get constricted. You could definitely make your way to your pre-pandemic highs on the NASDAQ. That would put you somewhere around 232. That could potentially be downside from here, from current levels, of about 35%. And I wish I didn't have to say that, but that's possible here, especially if you have a delusional Fed, in which we heard from today. The Fed is really pounding the table here. They might have to do more. You could easily see that. Don't be confused there. If the fear does continue to grow, money will flow out of stocks faster than the dang Nile River, okay? It will flow out of stocks, and you will see a sharp pullback in our market. So that is something you want to be watching for. Again, nothing happens until you actually do see that incursion into the Gaza Strip from Israel. Now, let's go ahead and take a listen to what Dan Ives had to say on Tesla stock's latest earnings.
Morning at Post 9, Dan Ives, Wedbush Securities Analyst, does cut his target to 310. He was at 350, but keeps the outperform rating. Dan, it's great to have you.
Great
Thanks for coming in. What about it? What made you say that?
I mean, if you looked up disaster in the dictionary, there'd be a video of last night's conference call. And I think the problem is that the street wanted to get details. Have the price cuts ended? What is the gross margin outlook? What does demand ultimately look into 2024? And instead, it was really Musk put on his macroeconomist sort of hat. And that's not what the street wanted. I think it was lack of details. And ultimately, it was a somber note for, especially when it looks at Cybertruck and you look at the margin outlook. And I think the long-term thesis is still there. But with no rose-colored glasses, I mean, this was definitely what I'd call a disaster.
Would you expect anything different from a guy who runs a company whose goods are 90% financed? Right? I mean, that's the automobile.
Yeah. Now, look, there's no doubt that that's something that's helped him and now hurts him. But Carl, I think the big issue is really around the price cuts, because as you've seen the price cuts, there was a view that it would start to end by this point. And ultimately, by having the door open, and also by losing your CFO, that was, I think, a huge part of the credibility, investors came off that call last night. I can tell you, institutionally speaking, just a lot more questions, no answers. And I think that's really the frustration, and that's why you're seeing the stock under almost extra pressure because of that head-scratcher conference call last night.
Dan, you're one of the biggest bulls on the street. You come here all the time and have talked up Tesla for years, correctly so in many ways. By the way, I'm glad you're here on a bad day, too. But what did you get wrong here?
I think what we got wrong in the short term was the price cuts were going to end. And you knew the poker move of the price cuts this year has paid off massively. And I think that's really showed from a demand perspective. But that really 95% of the price cuts, I believe, are done. I thought Musk would have put the line in the sand, maybe a few more price cuts, then we're over. Instead, by leaving the door open, I think the communication is maybe what we underestimate even from Musk. By not putting a line in the sand, that's the frustration here, because now it's a Pandora's box and you can't put the genie back in the bottle.
But how can he put a line in the sand on price cuts when we see the 10-year yield or the 30-year yield move up every single day to new highs? And if that's really what's driving it, how can you know?
Yeah, and it's a great question. I think it's really about the price cuts in China. And if you look what's happened there, even BYD and some others have started to soften some of the price cuts. And I think by continuing to cut prices, especially in China, that price war, they're actually making worse. And I think that's been the biggest thing, because you're talking about 40-50% of overall demands coming out of China. We believe the long-term story is intact. The sum of the parts thesis, full self-driving, AI, what they're going to invest in. But no doubt in the near term, because of that conference call, I think you're definitely going to see uncertainty. It's almost an albatross right now that's around that
Where
stock.
is the operating margin? 7.6%, I think, came in. How does that That's like closer to other automakers, right?
Well, yeah, because I mean, they were in a massive position of strength, come down toward other automakers, and now it comes down to, does this start to stabilize, increase from here? Obviously, software. You could argue FSD is going to be a big piece going forward. Look, we've been here before. We've seen it in 17 and 18. We've been through some of these white knuckle periods with Musk. But I would put last night as a top 3, probably worst conference call I've heard from Elon, in the last few years.
Now, as you heard, that was just not great from Dan Ives and ultimately from Tesla. That's kind of the most bearish I've heard Dan Ives on Tesla in a very, very long time. Now, Gene Munster sings a similar song as Dan Ives, but he does have more, I guess, concrete numbers that go behind Tesla fundamentally long-term that I think you guys should just really hear as well.
Struck a pessimistic tone, saying he's moving through the current environment with a degree of caution. Joining us now with more, Gene Munster, Deepwater Asset Management managing partner. Gene, good morning. I was just looking at the beginning of the third quarter. The estimate for the third quarter for Tesla was, I think, at 84 cents in earnings. The estimate got whittled down to 73. It comes in at 66. A lot of focus on the automotive margins once you exclude those vehicle credits for zero-emission vehicles. So where does that leave us here in terms of the earnings power, how much more they're going to have to deal with in terms of price cuts and margin pressure, and how does it feed into the whole story?
Well, margins are the critical point, Mike, and ultimately they need to improve those margins. Musk was clear, don't expect margins to move higher over the next year as they start to ramp Cybertruck. And so this is really the battleground. This is the center vortex of the whole Tesla story. It's about margins. Margins go up. That means that this is a tech company. Margins go down. It's a typical car company. And so that's why there's so much weight on that all-important automotive gross margin X credits. Now, just frame in one other detail there. It was 16.3% in the September quarter. It was 29% a year and a half ago. These margins are now approaching traditional automakers. Now, granted, traditional automakers lose a ton of money when it comes to their electric initiatives, but they are approaching those lower margins. And so, Mike, what does this mean? It means patience is a virtue. Elon talked about this being a challenging period. He used that phrase twice in his prepared remarks. He did not talk about challenges in the June quarter. And what essentially the setup here is that investors who believe that this is a tech company, I'm one of those, have to wait an extra year plus before we start to see some of those margins improve. There was another layer of disappointment on the call too, is Tesla has been steadfast with this 50% compound growth expectation. And Elon started to back off with some of that language, saying that it's just impossible to continue to grow at those rates. And so when we think about Tesla and the story for the next 5 to 10 years, that 20 million vehicle number in 2030 just got a lot harder after his commentary last night. And so that's the near term. It is disappointing. I am optimistic for longer term reasons, but it was not a pretty quarter.
Right. And, you mentioned that the margin profile has been trending toward traditional automotive companies. It's not there, but it's getting in that direction. As well as, Elon Musk complains about high interest rates. So they're having to cut price to create demand, whereas before it was all about supply constraints and unlimited demand. In other words, the story that got Tesla to an $800 billion market cap is not really there anymore, at least right in front of us, and it trades at 70 times earnings. So it's obviously a great operator with all these advantages, vertical integration and everything else, and certainly massive first mover advantage in EVs. But what do you pay for it?
Well, ultimately, I think you probably pay 5 or 6 times revenue. And the question is, what is the revenue going to be in the next 2, 3, 4 years? And this is, I think, where people need to look in the mirror and ask the question, which is ultimately, where is the world going when it comes to transportation? If the answer is maybe it's an electric world over the next 10 to 20 years, then Tesla's not going to get there. It won't get the bid that to keep the stock going. If the answer is that the world is going in that direction, I think the company is in a great position. And the reason why is that this addressable market, gets back to your question about what do you pay for this? The addressable market for automotives is massive. If you take the low end, it's just over $2 trillion a year. The high end, it's $2.5 trillion. The smartphone market's about $600 billion a year. So this is 4x the size of that. Tesla's got a pole position. General Motors just announced that they're backing off some of their plans to do for their light truck production facility. They basically postponed that by about a year and a quarter. The other automotive makers just are backing off on EVs. And so I think this is the period of where great companies have difficulties. And ultimately, I think that they will come out. I think you pay 5 or 6 times revenue. That's a hardware software model that Apple has. And where does that get you to? They'll do call it $25 billion in revenue next year. That probably goes to $500 billion over the next several years, and you can kind of fill in the multiple there.
So Gene Munster says Tesla could end up bringing in $500–600 billion of revenue for a given year. Assign a multiple to that. If you assign a 20% profit margin, that could be $100 billion. Times that by something along the lines of, call it 30 as a PE. Let's see what we get here. Times 30 could be a market cap of around $3 trillion. Potentially, go much higher than that. Just depends on, what ultimately happens, what the course ahead is going to be. That would be very nice gains for Tesla. And that's coming from a Wall Street analyst. That's coming from Gene Munster. Okay. That's not one of the most realistic long-term estimates, especially if robotaxi hits, energy storage, all of that. So I think he's saying a little bit more constructive things on Tesla. I think it's prudent to get other people's opinions, especially Wall Street, but take it with a big grain of salt. Obviously, the stock's going to be volatile. I see a lot more risk to the downside here than to the upside, but am I selling stock? Absolutely not. Am I changing my thesis on Tesla? Absolutely not. I mean, if I want to be honest with you guys, well, I find Elon a lot more credible now that he was just blatantly honest. And I do think it allows Tesla to some degree hit a rock bottom as long as earnings don't fall through the floor because the economic, situation does deteriorate. Pessimistically speaking, verbally speaking, you just hit a verbal floor on Tesla. It's not like Teslas can come out and say, the situation's worse from here unless we did actually go into recession. So if we avoid that hard landing, I doubt the verbiage gets worse from Tesla. And Tesla's in a much better position than Legacy Auto. So if you're Legacy Auto, after what Tesla just said, you are in big trouble, guys. So that is going to go ahead and do it for this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day. Let me know how low you think markets could fall. If you think stocks are going to rally from here, if you think stocks are going to fall from here, let me know all of that. How are you hedging your portfolios as well? Let me know down below in the comment section of this video. Again, if you guys want to come join the trading community, link down below in the description of this video. You guys enjoy the rest of your day and nights, and I will see you in the next one.